So we begin with its history and management. PChem was incorporated in March 1998 as a private limited company by the name of Kuantan Terminals Sdn Berhad as part of the Petronas Group. It changed its name to Petronas Chemicals Sdn Berhad on the 26th of October 2009 after an internal reorganization. In August 2010, it was converted into a public limited company and renamed Petronas Chemicals Group Berhad. Since 1995, they either began building their own plants, producing petrochemical products like ammonia and urea in Bintulu, to acrylic acids, as well as buying over interests from their joint venture partners, the likes of BP, BASF, Dow Chemicals and Idemitsu. By 2020, they had over 30 subsidiaries, either wholly owned to joint ventures and associates. They have a geographical footprint that spans the world from North and South America to Europe to the Middle East all the way to Japan as well as China. This was aided by the acquisition of the Da Vinci Group, their first foray into specialty chemicals industry. PChem is a constituent of the FBM KLCI with a current market capitalization of 55 billion at the point of this recording. Malaysians should be proud to have a company that actually spans the globe.
In a world of increasing energy demand, you need a partner with the right diversity, with the right chemistry for our partners, where sustainability of conduct is assured, providing innovative solutions and added value. A Fortune 500 company with presence in over 80 countries. We have been able to maximize our value while meeting global demand. For over 5 decades, we have revolutionized the oil and gas business landscape. We started the petrochemicals business since 1980s. While remaining focused on the core strengths and innovations that grow us further. Today, we have developed a diversified range of products, leveraging on our formidable expertise in core and specialty chemicals. We have created a diversified footprint through our integrated facilities through the region. Proven by our record year-on-year business performance, we are an integral value-add solutions partner, having steadily leveraged on our strengths, having made impressive revenue gains while remaining agile and responsive to market demands. Despite the challenges, we remain the leading chemical player in the region. We continue to deliver superior value through commercial excellence. Driven by our two-pronged strategy of strengthening basic petrochemicals while selectively diversifying into derivatives, specialty chemicals, and solutions. Our vision is further strengthened today through the broadening of our product portfolio in specialty chemicals. We are moving forward in meeting downstream market demands. We have accelerated our specialty chemicals to keep pace with the dynamic global megatrends. The Pengerang Integrated Complex. We're taking the step forward by investing in core growth segments while steadily increasing our output volume as an integrated value-add solutions partner, having steadily leveraged on our strengths. We are the partner that is highly integrated and efficient. The partner with customized innovative solutions. The partner with the right expertise. We remain committed towards delivering sustainability through all our operations, ensuring that we continue developing further revenue streams. In a world of growing complexity, we are capitalizing on opportunities with the right product diversity to build sustainable value for future global growth. The Petronas Chemicals Group's range of products, created and developed with our partners in mind, is all around us in the everyday products that help make life better. Optimizing value for our partners as the industry leader in Malaysia. Through our strategic position in Southeast Asia, our production capacity has steadily increased over the years to meet growing market demands. We are continuously delivering superior value through our commercial excellence by ensuring reliable quality product supply for customers all over the world. Today, we are turning challenges into opportunities with our two-pronged strategy of strengthening basic petrochemicals and going into derivatives and specialty chemicals to be agile and better serve our partners, manufacturers and industries. We collaborate with partners for high-value products, for customized cost-effective solutions, focused on innovation excellence. We continuously seek to establish and increase our presence in selected growth markets, giving our partners the critical edge through product diversity and innovation excellence. A partner that builds sustainable value, setting the course to your future. We are ready. Let's make it happen. We are Petronas Chemicals Group Berhad.
Petronas post record quarterly net profit in the first quarter for 2022 after the profit rise to 2.08 billion on the higher product price amid continued strong demand for the petrochemical reported profit. Revenue also increased by 42% year-on-year from 4.68 million to 6.3 million. Petrochemical did not declare a quarterly dividend. The quarter expects a strong performance in the first quarter of 2022 in all segments, particularly ammonia and urea overall, underpinned by the higher energy price amid continued strong global demand and supply disruption for petrochemical. We believe that this is due to increase in the prices. Managing Director and CEO Muhammad Yusof said in a statement that average price of its product increased by 20% to 60% year-on-year. He said product price have remained fully as a conflict between Russia and Ukraine continue to escalate despite seasonal easing of certain products. Despite all of the volatility, petrochemical vigilance and commercial excellence strategy ensure the group could meet its sales target despite certain cities in China being under COVID-19 lockdown for several weeks. Regarding the petrochemical growth project, Yusri said that the commissioning of the Pangeran Integrate Complex started in the early May as planned, and commissioning activity are progressing accordingly. Petronas Chemical Group Berhad share price fell slightly after the company reported a net profit of RM 1.87 million in the second quarter ended 30 June of 2022. Kenanga Investment Bank said in a statement, first half of 2022 performance was supported by improved the product price due to higher oil price, particularly due to lower asset utilization due to turnaround maintenance activity, and say that it meet the expectation. The company said in the second half of fiscal year 2022, we anticipate higher plant availability as no major maintenance work will be carried out. Kenanga maintain on outperforming call on the counter with the price target RM11. Meanwhile, MIDF Research reiterated its positive stance on the company financial performance for fiscal 2022. Rising energy price and tight energy supply continue to push product price higher. At the moment, we do not plan to make any changes for the earning guidance. Therefore, we will maintain our buy call and our price target at RM 11.93. At the 10:30 AM, Petronas Chemical fell 3 cents lower at RM 8.67, 667 and 800 share trading. Petronas Chemical Group Berhad seen a slowdown in demand for polymer product in particular and continue high energy costs during the China extended of COVID-19 lockdown. In the statement, Managing Director and CEO Muhammad Yusof say olefin and derivative price are expected to continue to fall until the restrictions are eased in China. But he say urea price are expected to remain high between $550 and $700 per ton as the energy price remain elevated due to ongoing war between Russia and Ukraine. For the third quarter and the 30 September of 2022, Petronas Chemical posts a net profit of RM 1.96 billion compared to the same period last year with RM 1.96 billion amid lower margin and lower contribution from joint venture and affiliate reported a net profit of RM 190 million. While the stronger US dollar have increased our sale, we have faced lower margin due to the higher operating costs, said Muhammad Yusuf. Group earnings per share decreased to 24 cents compared to 25 cents in the third quarter of 2021. And the revenue for the quarter was RM 7.03 billion, an increase of 21.96% for him to compare to the same quarter in 2021. This was due to the higher product price due in the stronger US dollar and higher sales volume. According to Muhammad Yusri, although lower than the second quarter of 2022, product price remained elevated in the quarter due to higher oil and energy price. The group production and sales volume have improved and factory utilization and rise from 72% in the second quarter of 2022 to 97%. About 70% of Petronas chemical output is exported to the Asia Pacific region, with Southern Asia account for about 40%. The company added.
Now, carry on with the ratio analysis. On the investing.com website, statistics regarding Petronas Chemicals Group Berhad's ratio is already provided. The ratio provided there is compared between the company and the industry, as can be seen in this table here. So first, let's look at the leverage. Leverage is broken down into two components: the most recent quarter's total debt to equity and the most recent quarter's long-term debt to equity ratio. In comparison to the industry, Petronas Chemicals Group Berhad's most recent quarter's long-term debt to equity was 6.73%, while the industry recorded about 24.11%, which means Petronas Chemicals Group Berhad is performing better than the industry as a whole, because long-term debt to equity ratios should be as low as possible in ensuring the company can make their financial obligations without problem. Then, Petronas Chemicals Group Berhad recorded a total debt to equity ratio for the most recent quarter of about 11.93% compared to the industry's 37.40%. This demonstrates that Petronas Chemicals Group Berhad can manage risk better than the industry average and can completely fulfill its financial responsibilities. Petronas Chemicals Group Berhad reported a quick ratio of 4.42% for liquidity in the most recent quarter, compared to 3.3 times for the industry. As a result, Petronas Chemicals Group Berhad is able to meet its financial obligations than the industry, because a higher quick ratio shows that the performance of the company is better. Meanwhile, Petronas Chemicals Group Berhad's current ratio of 5 is also higher above the industry average of 4.18. The current ratio is greater than 1. Therefore, according to the rule of thumb, Petronas Chemicals Group Berhad has enough working capital to pay all current liabilities, and it also has enough current assets to meet its current liabilities. Moving on to the profitability ratio, the return on equity (ROE) trailing 12 months TTM of Petronas Chemicals Group Berhad is 21.74%. The ROE of 5 years average of Petronas Chemicals Group Berhad is 14.20%. This means that Petronas Chemicals Group Berhad has a higher profitability compared to the industry, as the industry recorded only 18.97% and 12.70% for their ROE TTM and ROE of 5 years average respectively. The return on assets TTM for Petronas Chemicals Group Berhad is 16.29%, and the ROA of 5 years average for Petronas is 11.27%. Both ROA of Petronas Chemicals Group Berhad is higher and better compared to the industry, which recorded only 12.62% and 8.86% for their ROA TTM and ROA of 5 years average respectively. Then for Petronas Chemicals Group Berhad, they recorded approximately 17.08% and 12.69% for the return on investments ROI trailing 12 months and return on investments 5 years average, which also means that Petronas Chemicals Group Berhad can maximize their profit better than the industry. Other than that, Petronas Chemicals Group Berhad has a net profit margin trailing 12 months of 29.02% compared to 19.68% of the industry, and the net profit margin 5 years average of Petronas Chemicals Group Berhad consists of 22.41% and 15.77% for the industry. Thus, it means that Petronas has a better financial management in managing their company to maximize their profit.
And now let's move on to the horizontal analysis of Petronas Chemicals Group Berhad. First and foremost, I will present the horizontal analysis of Petronas Chemicals Group Berhad in terms of gross profit. As shown in the table, there is a decrease in gross profit from 2019 to 2020, which is from negative 35.18% to negative 48.72% respectively. On the other hand, in 2021, surprisingly, the gross profit increased to 24.79%. This means that the Petronas Chemicals Group Berhad is more effective in 2021 in using their resources to make and sell their products or services. Next, in the perspective of operating income, the company was having a decrease in 2020 as compared to 2019, which is from negative 42.81% to negative 61.17%. Therefore, decreasing operating income may spell trouble for the business in 2020. Meanwhile, for 2021, the operating income is positive with the percentage of 23.74%. This means that the growing operating profit is a positive indicator of financial health of Petronas Chemicals Group Berhad. The next item to be discussed in horizontal analysis of the company's income statement is net income. As the same as operating income, net income of the company in 2020 was having declining as compared to 2019, which is from negative 41.29% to negative 66% respectively. This means that the company was suffering a big loss and not a profit over the given accounting period. Otherwise, for 2021, the company's net income is positive with the percentage of 53.40%. From all the perspective mentioned, I could say that Petronas Chemicals Group Berhad was having a better financial performance in 2021 as compared to 2019 and 2020.
I will be interpreting regarding the vertical balance sheet for the Petronas Chemical Group Berhad. We will be using the data set from 2018 to 2021. Firstly, total current liabilities is the sum of all current liabilities. These are legal obligations of a company that the company expects to repay within a year. This is important in calculating the current ratio, as an increase in current liabilities means that the amount of short-term money that the company owns has increased. Liabilities are expected to arise from past transactions or events which are expected to reduce assets when they are settled. It is one of the three components of a company's balance sheet along with assets, shareholders' equity. The sum of liabilities and shareholders' equity will be equal to the company's asset. Since a company's assets are generally acquired using a combination of debt and equity, liabilities ultimately represent the portion of a company's assets that were funded by the debt obligations. Where the higher the result, it is the better, as a negative result will indicate that the company does not have enough assets to pay short-term debt and vice versa. As we can see right here, for Petronas Chemical Group Berhad, the total current liabilities for 2018 is 40%, where it decreased to 8% in 2019 and maintained the same 8% in 2020, but it has increased 3% to 2021, which is 11%. This is a good indicator and it shows that Petronas Chemical Group Berhad does have enough assets to pay their debt. For total liabilities, it keeps showing an increasing pattern from 2018 to 2020, where in 2018 it is 21%, in 2019 it is 23%, in 2020 it is 24%, and 2021 it shows 25%. This is a very good indicator as it shows an increasing pattern for the company, where it means that the amount of short-term money that the company owns has increased to pay their debt.
Based on the vertical income statement for Petronas Chemical Group Berhad, it shows that the gross profit for the year of 2018 is 35%, and for the year of 2019, it is decreased around 8% from 35% to 27%. And next, the vertical analysis for the year of 2020 is once again decreased around 2% to 25%. Last, for the year of 2021, it is increased around 12%, which is from 25% to 37%. The higher the profit is, the good performance for the company. Beside that, move to the operating income. For the year of 2021, it is the highest one, which is 30%, and followed by 2018 with 29%, and the lower operating income is for the year of 2020, which is 50%. After that, the net income for the Petronas. The net income for the Petronas based on the vertical analysis is the highest net income is for the year of 2021 with 32%, and followed by the year of 2018 with 24%, 17% for the year of 2019, and last is 11% for the year of 2020. The higher the net income is, the good.
SWOT analysis is a strategic methodology to analyze the strengths and weaknesses that Petronas Chemical possess and opportunities and threats that the firm faces because of competitive and macroeconomic factors prevalent in Malaysia. Strengths are the firm's capabilities and resources that it can use to design, develop and sustain competitive advantage in the marketplace. The first strength that Petronas Chemical have is brands catering to different customer segments within chemical manufacturing segment. Petronas Chemical extensive product offering have helped the company to penetrate different customer segments in chemical manufacturing segment. It has also helped the organization to diversify revenue stream. Second is strong brand recognition. Petronas Chemical's products have strong brand recognition in the chemical manufacturing industry. This has enabled the company to charge a premium compared to its competitor in chemical manufacturing industry. That is high margin compared to chemical manufacturing industry competitors. Even though Petronas Chemical is facing downward pressure on profitability compared to competitors, it is still raking in higher profit margins. These weaknesses of Petronas Chemical can either be absent of strength or resources of capability that are required, but at present the organization doesn't have. Leaders have to be certain if the weakness is present because of lack of strategic planning or as a result of strategic choice. First is extra cost of building new supply chain and logistic network. Internet and artificial intelligence (AI) has significantly altered the business model in the basic material industry, and given the decreasing significance of the dealer network, Petronas Chemical has to build a new robust supply chain network. that can be extremely expensive. Second is business model of Petronas Chemical can be easily imitated by the competitors in the chemical manufacturing industry. To overcome these challenges, Petronas Chemical need to build a platform model that can integrate supplier, vendor, and end user. Third is high cost of replacing existing experts within the Petronas Chemical. Few employees are responsible for the Petronas Chemicals knowledge base, and replacing them will be extremely difficult in the present conditions. Next is opportunities. Opportunities are potential area where the firm can identify potential for growth, profit, and market share. Opportunities of Petronas Chemical. First is increasing customer base in lower segment, as customers have to migrate from an organized operator in the basic material industry to licensed player. It will provide Petronas Chemicals an opportunity to penetrate entry-level market with a no-frill offering. Second is accelerated technology, innovation, and advances are improving industrial productivity, allowing suppliers to manufacture vast array of products and services. This can help Petronas Chemical to significantly venture into adjacent products. Next is rapid expansion of economy, as the US economy is improving faster than any other developed economy. It will provide Petronas Chemicals an opportunity to expand into the US market. Petronas Chemicals already know how to operate into the competitive US market. Next is threat. Threats are factors that can be potential danger to the firm's business model because of changes in macroeconomic factors and changing consumer perception. Threat can be managed but not controlled. The first threat for Petronas Chemical is shortage of skilled human resource. Given the high turnover of employees and increasing dependence on innovative solutions, Petronas Chemical can face skilled human resource challenges in the near future. Second is growing technological expertise of local players in the export market. One of the biggest threats of tie-up with the local player in the export market for Petronas Chemical is threat of losing IPR. The intellectual property right framework is not very strong in emerging markets, especially in China. Third is commoditization of the product segment. The biggest challenges for Petronas Chemicals and other players in the industry is the increasing commoditization of the product in basic material industry.
Axiata, a regional telecommunications and digital conglomerate with a footprint spanning 11 countries across ASEAN and South Asia. With a vision to be the next generation digital champion by 2024, we are well positioned to empower our consumers, homes, and enterprises to navigate the new normal towards a more sustainable future. Our three core businesses of digital telcos, digital businesses, and infrastructure are developed based on our deep insights into our customers' needs. From our digital telcos that are answering consumers' needs for unlimited digital mobility and enabling enterprises to digitally transform in their quest to drive their growth, to being a full-spectrum fintech player in Malaysia, we are advancing digital and financial inclusion for the unserved and underserved while helping brands drive their digital transformation and data maturity. Our tower company, E.co, currently the 7th largest tower co globally, continues to bridge the digital divide and catalyze the growth of digital economies across emerging Asia sustainably. Axiata is here to create value for all. In 2021, our revenue increased to 25.9 billion ringgit, EBITDA rose to 11.4 billion ringgit, and PATAMI surged to 818.9 million ringgit with a total cost savings of 2 billion ringgit. As the region's trusted digital partner, we are serving 163.1 million mobile customers and 185,000 enterprises across 11 countries. Having pledged 115 million ringgit over the next 10 years to Axiata Foundation, Our unwavering support to governments and communities include providing COVID-19 support and emergency and disaster response support across our footprint. E.co's Tower to Community projects have reached out to more than 11,000 families in Malaysia, Bangladesh, Pakistan, and Sri Lanka. We are focused on building a pool of modern, agile, and digital talents and have positively impacted over 13,100 employees. Axiata Cares is setting the tone at Corporate Center with a holistic approach to nurturing our employees' development. Underlying our employee value proposition is our commitment to diversity, equity, and inclusion. We are committed to minimizing our environmental impact through various efforts, and we're the first Malaysian telco to sign the Science Based Target Initiative in 2021. Axiata's national contributions represent the long-term value we have created through investments across our footprint. We are dedicated to continuously delivering economic, environmental, social, and governance value as we progress into a more sustainable future. Axiata, advancing Asia.
Axiata Group posted a net loss of 106.38 million ringgit for the second quarter of FY22 due to significant foreign exchange losses contributed by mobile operations in Sri Lanka. It made a net profit of 277.76 million ringgit in the second quarter of FY21. This is the second consecutive quarter that Axiata has been in the red, with a quarterly loss widening from 42.97 million ringgit in the preceding quarter ended March 21st, 2022. Revenue grew 4.9% year-on-year to 6.7 billion ringgit on higher income in all geographical segments except for Sri Lanka. For the first half of FY22, it incurred a net loss of 149.35 million ringgit versus a net profit of 353.32 million ringgit a year ago, while revenue rose 5.8% to 13.17 billion ringgit. The telco did not declare any dividend for the first half. Still, the group said it is confident that it will likely exceed its headline key performance indicators of mid-single-digit growth for revenue and high single-digit growth for earnings before interest and tax, based on operational performance through currency devaluation and inflation will have an unfavorable impact on the group's reported profit after tax and minority interest in 2022. Axiata's share price closed 1.62% lower at 3 ringgit 3 sen, giving the group a market capitalization of 27.8 billion ringgit. Permodalan Nasional is among a group of shareholders which is believed to have also included the Employees Provident Fund that have voted against Axiata Group's proposed 8.72 trillion Indonesian rupiah acquisition of a 66.03% stake in Indonesia's PT Linknet. Nevertheless, the resolution was passed as the telco managed to garner 57.83% of the votes of those present and voting at the extraordinary general meeting held. while 42.17% had voted against. The approving majority represented 4.837 billion shares, while the dissenting had 3.527 billion shares. Axiata Group Chairman Tan Sri Shahriar Reza Rizwan told reporters after the EGM that the dissenting voters were mostly concerned about the impact on its balance sheet. He said that they do not have time to explain to the shareholders that Axiata's balance sheet is manageable. He was, however, tight-lipped about who had voted for or against the resolution, saying that while they do not have the total number of votes, he didn't have the exact breakdown. After the EGM, PNB, who is Axiata's third largest shareholders with a 14.67% stake, said it had voted against the deal. On its website, PNB aired its concern over the proposal having an adverse impact on the financial performance of the company in the immediate term due to the potential increase in debt levels weighing on its cash flow and earnings. This, coupled with the lack of visibility on the impact of geopolitical developments on Axiata's international operations, PNB would be blocking the deal on concerns about its impact on the funding needs and gearing of Axiata, which is also in the midst of merging its mobile units, Celcom Axiata and TG.com. To recap, Axiata proposed the LinkNet acquisition in late January with a rationale that it intends to capitalize on the fast-growing fixed broadband market and enterprise market segments in Indonesia. Axiata said that it would be also create significant synergies for LinkNet and XL Axiata through sharing of networks and extensive relationship with customers in Indonesia.
Now, the ratio analysis of Axiata Group Berhad. The ratio of Axiata Group Berhad is also provided on the website of investing.com. According to the data, Axiata Group Berhad recorded about 126.32% for their long-term debt to equity for the most recent quarter, and the industry has a higher long-term debt to equity of 180.13%. Meanwhile, the total debt to equity for the most recent quarter for both Axiata Group and the industry are 236.07% and 379.91% respectively. Hence, both long-term debt to equity most recent quarter and the total debt to equity most recent quarter shows that Axiata Group Berhad is better than the industry, as a lower percentage ensure that the company can fulfill their financial obligations. For the liquidity, the quick ratio for the most recent quarter of Axiata Group Berhad is 0.55, while for the company is 0.74. According to the rule of thumb, a quick ratio that below 1 is not a good one. This means that both the company and the industry could not pay off their current liabilities several times over, and Axiata Group is doing worse than the industry. Moreover, the current ratio for the most recent quarter for both company and industry are approximately 0.59 and 0.82 respectively. This also shows that both company and the industry have a problem to pay for its short-term obligations, as the current ratio is less than 1. Last but not least, the profitability ratio. The ROE trailing 12 months of Axiata Group Berhad is negative 0.5%, while the ROE for 5 years average for Axiata Group Berhad is negative 1.23%. This means that Axiata Group has a lower profitability compared to the industry, as the industry recorded 66.44% and 84.31% for their ROE, TTM, and ROE of 5 years average respectively. The return on assets trailing 12 months for Axiata Group Berhad is 0.24%, and the ROA of 5 years average for Axiata Group Berhad is negative 0.21%. Both ROA for Axiata Group is lower and worse compared to the industry, which recorded 7.32% and 9.38% for the ROA, TTM, and ROA 5 years average respectively. Then, for Axiata Group Berhad, they recorded approximately 4.63% and 3.71% for the return on investments trailing 12 months and return on investments 5 years average. This means that Axiata Group cannot maximize their profit better than the industry, as the industry recorded a higher ROI TTM and ROI of 5 years average of 16.97% and 20.88% respectively. Other than that, Axiata Group Berhad has a net profit margin trailing 12 months of negative 0.31% compared to 11.99% of the industry, and the net profit margin 5 years average of Axiata Group Berhad consists of negative 0.62% and 13.88% for the industry. Thus, it means that a low profit margin that recorded by Axiata Group shows that the selling price they chose for a good isn't much higher from the cost itself. It indicates that Axiata Group Berhad is likely in a very competitive industry, offering products that aren't highly unique.
I will be explaining about the horizontal analysis for the Axiata Group. Firstly, all these data is in millions of Malaysian ringgit except for per share items. In 2019, the gross profit for Axiata Group is 11.86%, where in 2020 it drops to 11.42%, and at 2021 it has increased to 17.98% for the gross profit of Axiata Group. As for operating income, which includes of the total operating expenses, selling general and admin expenses, research and development, depreciation, interest expense, unusual expense, and other operating expenses, the operating income for Axiata Group at 2019 is negative 277.44%, where it drops to negative 204.60% in 2020 and drop more to negative 260.08%. As for net income before taxes, in 2019, the net income before taxes for Axiata Group is negative 168.25%, an increase to negative 128.75% in 2021 and dropped to negative 153.36% in 2021. For net income after taxes, it shows a increase and decrease pattern, where in 2019 it is negative 136.49%, in 2020 it is negative 112.54%, where in 2021 it is negative 125.67%. As for net income before extraordinary items, it keeps showing a decreasing pattern from 2019 to 2020, but in 2021 it has more decreased to negative 117.20%. From 2019 it is negative 130.61%, and 2020 negative 107.67%. The net income for Axiata Group is the same as the before extraordinary items, as there is no extraordinary items available in Axiata Group. For income available to government excluding extraordinary items, it increased first from 2019 to 2020 and decreased from 2020 to 2021.
After that is the vertical balance sheet for the Axiata Group. The total asset for the year of 2018, 2019, 2020 and 2021 is all same, which is 100%. This show that a very good performance for that company because have the highest total asset, which is 100%. And here you can see this is the item under the total current asset, and this is for the total asset. Next, we move to the total current liability. For the year of 2018 is 29%. For the year of 2019 is increased from 29% to 37%. Then it dropped to 26% for the year of 2020. But for the year of 2021, it is started increase to 28%. It is good performance for the company if they have the lowest total current liability. So based on the 4 years that I researched, for the year of 2020 is the best year because have the lowest total current liability. This is for the current liability. Next is total liability. For the year of 2018 is 70%, 2019 is 76%, 2020 is 74%, and last for the 2021 is 75%. Last, we talk about the total of equity for Axiata Group. And last, the item for the total equity. For the year of 2018 is 27%. For the year of 2019 is 24%. Years of 2020 is 26%. And the last is 2021 is 25%. Based on what I had learned, it is good if the company or the group have the highest percentage for their equity. This is because when we have the highest equity, the company or the group will have a low risk.
The gross profit has increased from 2018 to 2019 by 6% in the Axiata Group Berhad. We can assume the reason will be that Axiata Group sale has increased between the financial year 2018 to 2019. However, the gross profit for the year 2019 until 2021 remained constant at 67%. The administration cost has decreased by 4% in 2018 until 2021. Meanwhile, the depreciation is decreased from 2018 to 2019 by 2%, increased by 5% in 2020, and lastly decreased back in 2021 by 4%. In addition, the operating income has increased by 25% from 2018 to 2021. We can assume the reason is that the sales have increased and total cost decreased in that financial year. The income tax has decreased by 1% from 2018 until 2021, and this is relative with the profit before income tax. The sale of Axiata Group Berhad has increased in ringgit in 2021. As a result, the profit for the year 2021 also increased by 1% from the previous year. The total cost remained constant and income tax also increased by 1% in 2021.
Strengths, weaknesses, opportunities, and threats. SWOT analysis can help the brand focus on building upon its strengths and opportunities while addressing its weaknesses as well as threats to improve its market position. The strength of Axiata Group Berhad looks at the key aspect of its business which give it competitive advantage in the market. Some important factors in a brand's strength include its financial position, experienced workforce, product uniqueness, and intangible assets like brand value. The first strength of Axiata Group Berhad is that they have strong brand recognition. Axiata products have strong brand recognition in the industry. This has enabled the company to charge a premium compared to its competitors in communication services industry. As one of the leading telecommunications groups in Asia, in pursuit of a vision to be the next generation digital champion by 2024, Axiata has transformed itself from a holding entity with a portfolio of pure-play mobile assets into triple-core strategy-driven business focusing on digital telco, digital businesses, and infrastructure. Axiata Group Berhad has won numbers of awards which happen to be the reason why they are well recognized nationwide. Next, Axiata Group strength is talent management at Axiata and skill development of the employees, where human resources are integral to the success of Axiata and communication services industry. The group has initiated the Axiata Development and Professional Training Program (ADAP) that aims to set you up for success in your future career trajectory. Through a 12-month placement in one of Axiata's companies, you will benefit from in-person and virtual training programs that will help you develop essential skills and digital knowledge, giving you an edge in the job market. And lastly, for strength of Axiata Group, they diversify into many segments where diversification is a corporate strategy to enter into a new products or product lines, new services or new markets involving substantially different skills, technology and knowledge. Axiata offers its services under some products which is Axel, ADA, Celcom, Dialog, Robismart and Cellboost, Aspirasi, ABK and Adeco brands. The company has investment in mobile operators, network infrastructure and digital internet companies. Weaknesses of Axiata can either be absent of strengths or sources of capabilities that are required, but at present the organisation doesn't have. The first weaknesses for Axiata Group Berhad is that they have declining market share with increasing revenues. The communication services industry is growing faster than the company. In such a scenario, Axiata has to carefully analyse the various trends within the services sector and figure out what it needs to do to drive future growth. Next, loyalty among suppliers is low. Given the history of Axiata coming up with new innovation to drive down prices in the supply chain, this can lead to competitors gaining advantage in near future. Opportunities are potential areas where the firm can identify potential for growth, profits and market share. For Axiata Group Berhad, their very first opportunities is customer preferences. Driven by rising disposable incomes, easy access to information and fast adoption of technological products, customers today are more willing to experiment or try new products in the market. Axiata has to carefully monitor not only wider trends within the communication industry, but also in the wider services sector. Axiata Group has to make use of opportunities in online space, where increasing adoption of online services by customers will also enable Axiata to provide new offerings to the customers in communication services industry. Next, the group shall seek opportunities in population growth and urbanization, as customers have to migrate from unorganized operators in the services industry to licensed players. It will provide Axiata an opportunity to penetrate entry-level market with a no-frill offering. This is due to increase in government regulations are making it difficult for unorganized players to operate in the communication services industry. This can provide Axiata an opportunity to increase the customer base. Lastly, rapid expansion in economy. As the US economy is improving faster than any other developed economy, it will provide Axiata an opportunity to expand into the US market. Axiata already have know-how to operate into the competitive US market. Threats are factors that can be potential dangers to the firm's business models because of changes in macroeconomic factors and changing consumer perceptions. Threats can be managed but not controlled. For Axiata Group Berhad, changing political environment is a threat, as with US and China trade war, Brexit impacting European Union, and overall instability in the Middle East can impact Axiata business both in local market and international. Next, growing technological expertise of local players in the export market. One of the biggest threats of tie-up with the local players in the export market for Axiata is threat of losing IPR. The intellectual property rights framework is not very strong in emerging markets, especially in China. As well as the other two, competitive pressures is also a threat to Axiata Group Berhad, as the new product launch cycles are reducing in the services industry. It has put additional competitive pressures on players such as Axiata. Given the large customer base, Axiata cannot respond quickly to the needs of the Asian markets that disruptors are focusing on. Even though at present the Axiata is still leader in product innovation in the communication services segment, it is facing stiff challenges from international and local competitors since they are catching up with the product development.
Next, I will talk about the ratio comparison between Petronas Chemicals Group Berhad and Axiata Group Berhad, and I will show you which company is more worth to invest. When comparing the quick ratios for the two components, Petronas Chemicals Group Berhad has a greater quick ratio than Axiata Group Berhad. A company's ability to create cash rapidly in an emergency is indicated by a greater quick ratio. Since Petronas Chemicals Group Berhad has a higher quick ratio than the Axiata Group Berhad, this is a positive investing indicator, but it's also important to remember that a very high quick ratio can always be desirable. For instance, a business might have a sizable cash reserve. This money could be invested in new markets or utilized to fuel business expansion. In addition, when compared to Axiata Group Berhad, Petronas Chemicals Group Berhad also has a greater current ratio. Theoretically, a high current ratio indicates that a corporation is adequately liquid and can quickly settle its current liabilities with its current assets. As a result, an organization with a current ratio of 2.5 times is thought to be more liquid than one with a current ratio of 1.5 times. This demonstrates that Petronas Chemicals Group Berhad is more capable of meeting its obligations than the Axiata Group Berhad. Axiata Group recorded a higher long-term debt-to-equity ratio than the Petronas Chemicals Group Berhad, which has a lower long-term debt-to-equity ratio. Since the long-term debt-to-equity ratio is comparatively high, Axiata Group Berhad is therefore at a higher risk of bankruptcy because it may not be able to pay the interest on the debt if its cash flows decline. In contrast to the Petronas Chemicals Group Berhad, which has a lower total debt-to-equity ratio, Axiata Group Berhad likewise has a greater total debt-to-equity ratio. The debt-to-equity ratio displays the level of debt held by a corporation. Lenders and investors view a high debt-to-equity ratio as risky since it implies that the corporation is funding a sizable portion of its prospective growth through borrowing. Therefore, given that Axiata Group's total debt-to-equity ratio is fairly high, Petronas Chemicals Group Berhad is a far better investment for investors to consider based on the ratios comparison of both firms. Moreover, it demonstrates that Petronas Chemicals Group Berhad has a greater ratio in comparison to the Axiata Group for the 5 years average return on equity. A higher return on equity is typically a positive indicator for a company. A greater ROE indicates that a business is using the equity of its shareholders to produce income effectively. Low ROE indicates that the company's earnings are insufficient when compared to the equity of its shareholders. In light of the return on equity, we can say that Petronas Chemicals Group Berhad is a superior investment option versus Axiata Group Berhad, which regrettably has a negative return on equity ratio for their 5 years average. The net profit margin for the 5 years average for Petronas Chemicals Group Berhad and Axiata Group Berhad can then be compared, and we can see that Petronas Chemicals Group Berhad has a higher net profit margin than Axiata Group Berhad. Commonly, a company that has a large net profit margin is able to successfully manage its costs and charge a price that is much greater than its input cost. Consequently, a high ratio may be caused by efficient management, which indirectly implies that the Petronas Chemicals Group Berhad has a better management team in cost control and profit maximization. Not to mention, Petronas Chemicals Group Berhad appears to have a greater asset turnover ratio than the Axiata Group Berhad when comparing their asset turnover ratio for the trailing 12 months for the two businesses. A corporation with a high asset turnover ratio is extraordinarily good at generating a lot of income from a small number of assets. The asset turnover ratio, like other business indicators, works best when used to compare various businesses in the same sector. As a result, we notice that Petronas Chemicals Group Berhad is a better alternative for us to invest in than the Axiata Group Berhad, which is currently performing worse than Petronas Chemicals Group Berhad. Finally, as a result, we can conclude that Petronas Chemicals Group Berhad is the best choice to make an investment rather than Axiata Group Berhad. We can see that Petronas Chemicals Group Berhad is performing better than Axiata Group Berhad according to all the data provided.